Hello, I'm Alexander Lin. I am the co-founder and general partner at Reforge, and you're watching Take You Stock.
Two minutes to go into the close. Markets expected to finish for the final tail of the tape. Not just in negative territory, but at session lows. A bit more aggressive selling here in the last half hour or so for the S&P 500. That plus the Dow plus the NYSE composite indexes all finishing yesterday's session in record high territory. Not so much the tail of the tape for this Wednesday, January 7th, the first trading Wednesday of 2026. Healthcare and discretionary, those are your outperformers of the 11 sectors in the S&P 500. Though we are seeing losses to the downside today, led by utilities, industrials, and materials. Welcome to the show. They're all fired up to go. Welcome to the broadcast. You're watching Taking Stock. I'm your host, JD Durkin. Mere moments away from the ringing of the iconic closing bell down here at the big board. Volatility up on the day. Yields are down. The oil benchmarks are down as well. Both WTI and Brent not quite down to their 52-week lows, but not very far off. Precious metals, gold and silver down on the day as well. And the crypto majors, Bitcoin, Ethereum, and Solana all selling off in today's session. More than 2%. This crowd is fired up and ready to go. We got SKO 26 here at the big board. I can't even hear myself think, because this is what it's all about. Time now for the closing bell from the New York Stock Exchange. With the strike of 3 gavels on the sounding board, that officially brings about a close. Honestly, we could just do that for the entire half hour. Final tail of the tape. The S&P 500 will finish down 0.3%. The Dow will finish down, let's call it a full percent. The NYSE composite index, after yesterday's record-setting close, selling off 1% in the session, and the small caps not as bad maybe for the Russell 2000 as you would expect for a risk-off day. The Russell selling off 0.3%. Advance to declines tell us pretty negative breadth across the tape today. Sellers firmly in control of price action. Decliners outpacing advancers. Let's bring in my good pal Cullen Roche. He is the founder and chief investment officer at Discipline Funds, also author of the new book, Your Perfect Portfolio, which we'll get to in just a bit. Thanks for being here.
Yeah. Dude, I can't believe all these people showed up for me.
They all came for you. They all came for your book as well. I mean, let's take a look up here at the big board. A bit of a selling here into the close. We're finishing right at session lows, but right off the backdrop of all-time highs. What are you seeing for price action to kick off the year?
I mean, not really that surprising. We've got super high valuations, especially in the United States. The CAPE ratios at near all-time highs, and so I think this is something that investors might need to get used to. A little more volatility. Expectations are so high that it takes a lot to maintain the sort of momentum that we've had in the last couple of years.
Talk to me a bit more. What key components of the valuation conversation are you looking for retail investors who want to know, hey, I might want to get in to some of these high value names. Maybe they're just a little richer than they should be.
Yeah, it's tough. What I try to communicate to people is that high valuations are high expectations. That means that the time horizons over which we expect future returns to transpire might take a lot more patience than we're normally used to. So looking at things like international value stocks, things like that maybe have a little less volatility expectations in the future compared to things like technology, growth, and AI. I think, if you're impatient, the AI stuff, the tech stuff is going to be tough to hang on to.
Yeah, I mean, last year in 2025, a lot of outperformance, no big surprise from technology, from discretionary as well. In the lens of rotation on a day like today that's risk off, we see healthcare outperforming. What sectors do you like for 2026, and are there any you're a bit more bearish on, Cullen?
Yeah, well, I think, again, going back to kind of the time horizon perspective, things like tech growth, compared to things like consumer staples, consumer discretionary, utilities, those are things that are going to be a lot more stable in all likelihood in the years ahead compared to the growthy sort of sexy stuff that we've all seen the high returns from.
I want to ask you about new ETFs that you and the team at Discipline Funds are involved with. What's at the top of your radar you think our viewers might want to learn a little bit more about, Cullen?
Yeah, they're time weighted, so they're really unusual in the sense that they rebalance back to specific time targets, so 5, 10, and 20 years. Our 20-year fund is really fascinating because when I built it to be really aggressive. And then when I actually run the algorithm on it, it turns out that to get to 20-year target, because everything else in the tech and growth space is so long duration right now that actually you end up having to rebalance to, it basically came out to like a value domestic fund and an international value fund. So even though it's an aggressive fund, it's all equities, it's still from an equity specific component, it's very safe looking relative to things like, AI and growth and all the sort of, high flying stuff that we've seen in the last few years.
Yeah, time weighted, not market cap weighted,
Yep.
not price weighted like the Dow. That's an interesting point of comparison there. Before we let you go, the new book is called Your Perfect Portfolio, just came out yesterday?
Yesterday.
What's it all about?
It's about finding the right portfolio for you. So I didn't name the book The Perfect Portfolio specifically because the main message of the book is that there is no perfect portfolio, and you have to find a portfolio that you're comfortable with, that you understand, that you can stick with, and that's going to be your perfect portfolio. And so we do it's a huge case study of like 20 famous different strategies. I try to rip them apart and sort of independently and objectively analyze them all and give you the pros and the cons. And the best part is I tell people exactly how to implement every single one.
The new book is called Your Perfect Portfolio. Get it wherever you buy your books. The author, Cullen Roche, founder, chief investment officer at Discipline Funds. Thanks a lot for being here. Great to have you to kick off the broadcast, my man.
Great seeing you, JD.
What a pleasure. Josh will grab your mic. Jeff, you and I are going to head this way and go for a walk. As I do my best to awkwardly walk backwards through this crowd and not bump into anyone, we'll bring you the latest Poly market odds as more than $170 million in total trade volume wagered on the question, excuse me, one and all, what will the Fed decision on short-term interest rates be for the upcoming FOMC meeting in January? 92% odds, no big surprise, of no change. 9% odds, there is a cut of 25 basis points, just a 1% chance of a 50 basis point cut. The next meeting, January 27th and 28th. The 28th press conference, of course, will be one of the last ones with Jerome Powell as chairman of the Federal Reserve. Before we toss the break, we'll take a look at two NYSE notables. How about Eli Lilly shares from big pharma giant reaching a fresh all-time high on Wall Street today? Analysts from UBS lifting their price target from $10.80 to $12.50 on the stock. Reports of a deal to buy Ventyx Biosciences today, boosting both stocks in response to that news. Shares of Eli Lilly up 43% over the last 52 weeks. And finally, we'll take a look here at Salesforce. This is CRM having a strong session. RBC Capital analysts lifting their price target on CRM from $250 up to $290. The stock very much had a bumpy 2025, losing 20% of its value over the last calendar year. But here on Wall Street, it is now up for a third consecutive day. The average one-year price target for Salesforce sits at $330 a share, upside potential off these current levels of about 23%. Last week down here on the trading floor of the big board, I sat down with Joe Benaroche. He is the head of media partnerships, content, and distribution here at the New York Stock Exchange to talk all about the launch of a show called Taking Stock. I think that's this one on Reach TV. Take a look. Join us now at the FinTech TV set, Joe Benaroche. He is the head of media partnerships, content, and distribution here at the New York Stock Exchange. Great to have you.
Well, thank you. You're an incredible part of our team.
And a very happy New Year to you as well. We are so excited to launch Taking Stock, our daily closing bell show here at the big board on Reach TV. Joe, from where you're situated, why was this the right time? And why is this the right partner?
Right time because the NYSE is continuing to scale all of its resources across our marketing, our media, our content, all of our distribution, everything that we're creating on behalf of all of our listed companies, all the tens of thousands of private companies that we work with. All of those media and marketing resources continue to be a massive investment for us. And when we look at the last year, we have scaled partnerships almost 30 times more than we've had ever. We've increased all of our distribution by, tens to hundreds of million. And Reach TV is a natural part of that extension, considering where the business community ultimately rests. If you think about all of the travel, everywhere that they have all of their locked-in already distribution network, Reach TV is a perfect extension. So if you put us on paper, we're automatic partners. as an extension of our wonderful partnership with FinTech, the things that we're doing with Money 2020, everything that we're doing with Cheddar, everything that you're involved in, it was a very natural fit to make sure that, the people that we are consistently trying to reach every day had access to all of the information that we're putting out in the marketplace.
Joe, when you take a look at the broader New York Stock Exchange community today, I wonder how different is the way that you're thinking about distribution, even compared to where we were this time last year?
Well, this time last year, it's a perfect way to look at it. This time last year, we had just launched what we called Partnership Day, or we were gearing up for Partnership Day in February. We were essentially opening ourselves up as an organization, no different than any other media organization. So I have, a long history at NBC Universal, and those media organizations do what they call an upfront. And that upfront is basically to put out upfront into the marketplace all of the ways in which they can partner with you. Well, the New York Stock Exchange did exactly that. So from a year today, we have more creative partners, more content partners, more media partners that are coming not just to the floor, but that we're working with, more platform partners. We're looking at all of the new content creators. We have a wider distribution network. We have, I think we've increased the content that we've created almost by 100% year on year. We have, 1 million downloads to our podcasts alone. We have about 200 million reach on all of our distribution on the content that you're creating, that, Kristen Scholler and Ashley and team are creating. And why that's important is because the New York Stock Exchange views itself as a way to impart the information and narratives of all of those companies that I had mentioned earlier, all of those listed companies and all of those tens of thousands of private companies and all of the partners that we work with. So having that distribution is really important for us, but it all centers around the partnerships that we create, because we don't view ourselves as competitive to any other news network. That's not what we want to do. What we want to do is we want to be a partner to any content creator or any news or media organization.
This is an iconic institution. We draw our origins all the way back to 1792. The building, this iconic trading floor you and I are sitting on, this building opened up all the way back in 1902. But the audiences that we distribute our content to, the audiences are everywhere. How has the New York Stock Exchange continued to adapt that content strategy to actually meet people where they are?
That's a good question. And what I like is that you talked about our history. We are a 233-year-old organization. The New York Stock Exchange has rode and been a part of every single wave of technological innovation, from the from the telegraph to AI to every single platform that exists, from space to electronic vehicles. We have seen every wave of technology from 1792 to today. And so as part of that, we have platforms that are naturally part of the New York Stock Exchange, the fabric of our listed companies, and we work with every platform. We work with every single organization that is working to adapt AI within the fabric of their own company. And so for us, it's just very natural that what we're doing is working with every content creator or every platform. I'll give you an example of a platform, LinkedIn. While LinkedIn is a platform that has 1 billion people that they're connecting around the world, and they're connecting all of these businesses, they're also a publisher of news. So they will be right here on the floor, no different than the things that we're doing with X or the things that we might be doing with Snap, who's a part of our listed community.
Joe Benaroche, Head of Media Partnerships, Content, and Distribution right here at the one and only New York Stock Exchange. Joe, thanks a lot.
Thanks, my friend.
Welcome back to the show. Time now for the latest headlines you need to know on this Trading Wednesday in the worlds of fintech, cryptocurrencies, and artificial intelligence. First up, the crypto majors all selling off quite a bit here on Wall Street today. Bitcoin selling off 2.8%, ETH down almost 5%, and Solana selling off 3% today. All this comes as lawmakers are pushing forward with a sweeping crypto market structure bill in the Senate Banking Committee. But with votes still up in the air, the path to real regulatory clarity remains uncertain. And finally, MSCI scrapping plans to drop crypto treasury companies from its global indexes. could be a bit of a signal of a rethinking of how digital asset heavy firms are classified. Now join us here on the floor of the big board, someone far smarter than I am in the world of cryptocurrencies, our good friend, the great John D'Agostino. He is head of strategy at Coinbase Institutional. Thank you for being here.
Thank you so much. Two JDs talking crypto. I love it.
This is what it's all about. Two JDs talking crypto. This should be a branded segment that we do here on the show. How should we view the price action for the crypto majors? We finally saw Bitcoin and the others regain a bit of steam the last few days, and then you have a day like today where you're reminded maybe we're not totally out of the woods just yet, John.
Look, despite a day like today, if you look back at the last 3 months since the liquidity catastrophe of October 10th, we've seen a steady, grinding recovery driven mostly by institutional participation. So while during the end of year, a lot of retail sentiment was horrifically negative, institutions didn't back down at all. The work they put in earlier in 2025 carried through Q4, and now we're seeing a steady, grinding recovery despite today's volatility.
Talk to me about DeFi versus centralized trading. Where do you fall on this, and what more should we know?
Sounds incredibly complex, and people want to pit one against the other, like want to pit gold against Bitcoin. Gold and Bitcoin work well together. DeFi, decentralized finance, works very well with centralized trading. We've always had DeFi in capital markets. It used to be called the OTC, over-the-counter market, and generally it dwarfed the listed market that you would see on the floor. It's no different in crypto. You have people who want to trade peer-to-peer and people who want the comfort of trading through a centralized exchange. The two work very well together.
How should we view the conversation of correlation? Because after that October 10th event, a lot of people tried to say, well, it's correlated to tech and discretionary, maybe it's not correlated to equities. How do you view it for the rest of us to become a little bit smarter in the crypto space?
You gotta be really, really careful about this because unfortunately with all assets, they're not correlated until they are. And it usually is at the worst possible time. The reality is capital flows are controlled by a bunch of big, large players. They tend to think in the same way. A lot of them are in Chicago, the prop shops, the market makers, and when things go bad, when it's risk off, most risk assets, including equities, including most forms of credit, including commodities, and including crypto, correlations tend to inch up. But the good news is, if they behave in a non-correlated or less correlated fashion through the normal course, they can still be very important for a portfolio.
That's an awesome answer, and I appreciate the much needed context here. This is, of course, a midterm election year, so you and I were talking before the show. If you're a member of Congress, your foremost focus, whether they admit it or not, is probably re-election, but they have to keep the lights of the federal government on. They got no shortage of tasks on their plate. Where do you fall in terms of things like the Clarity Act or additional actual laws that lawmakers can pass to help the general crypto conversation?
So I'm still super hopeful. I mean, as you mentioned, we're in the middle of kind of political wrangling over the Clarity Act. Some good news coming out the last couple of days. I'm not sure where the Poly market or Kalshi prediction markets are on the Clarity Act passing. I'm hopeful though. The good news is regardless of that, we have an incredibly progressive, incredibly proactive CFTC and SEC that are passing pro-innovation rules all day long, every week. That's going to help us whether or not Clarity passes.
Anything else that's big on your radar, especially in the world of tokenization as we now roll forward past the new year into 2026?
Tokenization is just a fancy word for the next evolution in how we transfer value. At one time we traded paper tickets literally here on this floor. It moved to what we call upstairs, electronic trading. All tokenization is that next generation of technology that carries value from you to me. The difference is tokens can be smart and programmable, so they can solve things that traditional ledgers and ways of sending value can.
John D'Agostino, head of strategy at Coinbase Institutional, one of our favorite go-to professional voices to understand all things crypto and beyond. Great to have you, my man. Thanks for being here as always.
Always, JD.
Folks, don't go anywhere. Much more Taking Stock coming up live from the big board after this. Let's do it, folks. Welcome back to the show. You're watching Taking Stock live from the trading floor of the New York Stock Exchange. Time for the latest headlines in the worlds of startups, raises, and rounds. First up, AI benchmarking startup LM Arena raising $150 million at a valuation of $1.7 billion. All of this less than a year after the company launch, as investors bet on tools that measure large language models. Next up, fresh off its Hong Kong IPO, AI-driven biotech Insilico Medicine signing a potential $888 million drug development partnership as Big Pharma embraces AI to speed up cancer research. And finally, at this hour, crypto data firm The Tie set to buy staking provider Stakin. It's an all-cash equity deal, marking a deeper move into core digital asset infrastructure. We'll be right back with much more Taking Stock after this, including a sit-down you do not want to miss with former Republican Congressman Dave Brat. More Taking Stock coming up.
Hey, welcome back. David Struzeski here with FinTech TV. So excited to have David Brat with me here today.
Yeah.
Longtime contributor to the War Room with Steve Bannon.
Yeah.
Going years back.
Yes.
So, Dave, I'm really excited to have you here on FinTech TV.
Yeah.
At Money 2020.
Yeah.
You know, FinTech TV is about digital assets. We want to bring the right voices out,
Right.
emphasize the right leaders of the
Good.
future. As we're seeing the world change,
Yeah.
we want to bring the right understanding to this.
Yeah.
And so at FinTech TV, we often interview many people, and so excited to have you here from Liberty University.
No, thank you. And thanks for doing we just did an earlier piece on Liberty University and some big ideas. But I want you to share with Steve Bannon and RAV, Real America's Voice, and the Rumble crowd we have. It's a few million people. Tell them what's going on in this DeFi movement and why the kids are so excited about it and the crypto piece. How does that all work together kind of as an independence movement in the realm of finance?
Blockchain technology is designed to be decentralized,
Yep.
independent in the way that you are going to be protected, your information protected.
Right.
You're not going to be, hacked. It's not going to be counterfeited.
Yeah.
And ultimately, it's going to provide more efficient and effective ways of doing like average everyday things. What blockchain technology ultimately represents right now is the future of how these things are coming together. So
That's you brought up I think you're bringing up the '08 bailout, the biggest financial crisis of our day. And Bannon, and the war, he says that was the launching pad of kind of the freedom movement, the Tea Party movement, the move against and the U.S. Treasury Secretary Bessent right now who says it straight out. He says, "Hey, Wall Street, you had your turn. Now it's time for Main Street."
Right.
And so, how is it that FinTech TV and the Bitcoin piece and all that plays into and the blockchain technology plays into that? Why won't that happen again, or be as likely to happen again?
well, the system has so much leverage in it right now
Yeah.
that things just kind of get out of control. In fact,
Yeah.
just recently, the banks were able to lower their reserve requirements once again because the Fed's not dropping rates in a way that's fast enough.
Right.
So ultimately, Powell allowed them to go deeper into debt with fewer reserves. So blockchain is one for one.
Yeah.
It's backed up. And so you've got somebody that you want to send money to, or let's just say that we even want to buy a piece of real estate.
Right.
You and I like each other, but
Yeah.
we don't even have to like each other.
Right.
I've got a house, there's property that's involved.
100%,
What we're going to have is a clean exchange.
Right.
And ultimately, Web3 is
Yeah.
going to be able to put together the mortgage component on this. It's going to get the utilities components
Right. I've been
integrated.
hearing that. Unreal.
And so
It's unreal.
then once we integrate that with AI,
Yeah.
which is going to be able to make things more efficient and effective,
Yeah.
ultimately we have a real system that's going to, I don't know, it's just going to be a lot more efficient.
Thanks for what you guys do. Give the War Room your coordinates. How do they get a hold of you guys?
Yeah, hey, you can find us on FinTech TV. We are actually the Truth Plus business outlet channel, and so we've got news coming to you every day. You can see us in the airports. You can see us in the hotel rooms all over the place. And so over 50 million people are watching us regularly.
Man, wow. Congratulations, brother. Thanks for sharing Liberty and the ideas. It's great.
Pleasure's mine. Thanks for having me.
man.
Welcome back. I'm Scarlett Sieber from Money 2020, and this is Jargon Translator, where we decode the finance slang that sounds like agriculture, but it is all about crypto gains. Today's term, yield farming. Yield farming is basically earning interest on your crypto by lending or staking it in DeFi platforms. You lock up your tokens, and in return, you get reward, usually in more tokens. Think of it like putting your money in a high-yield savings account, except instead of at a bank, it's a smart contract running on the blockchain. Why do people love this? Because the returns can be wild, sometimes way higher than traditional banks. We're talking double-digit APYs that make your 0.01% savings account look like a joke. And for a while, during the DeFi boom, people were stacking tokens like they were stacking sneakers, and I love my sneakers. But here's the catch. It is risky, like really risky. Smart contract bugs can drain your funds overnight. Platforms can get hacked, and token prices, they swing harder than a TikTok trend cycle. You might earn 100% APY in tokens, but if that token crashed by 90%, your farm just turned into a desert. And then there's the impermanent loss, a fancy way of saying you can lose money even while providing liquidity. It's like planting seeds and watching the soil disappear. This is brutal. Yield farming exploded during the DeFi summer of 2020 when everyone was chasing insane returns. Today it's still around, but the hype has cooled as regulators start paying attention and investors realize free money usually comes with the fine print. Next time you hear yield farming, don't picture tractors, picture crypto hustlers chasing APYs like their trending TikTok sounds. Yield farming, when your money works the fields, but sometimes the harvest is just weeds. And that is your jargon translated.
Hello and goodbye. Have a good night. We'll see you tomorrow. Woo!